Chicken Genius Singapore is a YouTuber that recently quit YouTube, okay? And that kind of, started my whole thing about talking about YouTubers quitting and stuff. And as you can see, he has 290,000 subscribers. He's investing in companies that change the world, right? And, he quit YouTube because of negative comments and, the things that I was talking about. But I want to play you a few of his videos and make a reaction to it, because he was talking about value investing, okay? He was talking about value investing, and it made me realize that there's so many people out there that don't understand what value investing is, okay? And so I want to help you understand what value investing is, because people like him, unfortunately, destroyed a lot of financial futures for many, many people that followed them because they don't have a good understanding of investing, but they come across as if they did. Let's listen to this video, why value investing is outdated, how to invest in 2020. Warren Buffett. Let's have a listen.
Friends, if you are doing value investing now, there is an extremely high probability, 90% in fact, that your returns are not as good as the overall market, the index, or worse, losing money, like Warren Buffett. If you are in the 90%, I'm going to explain to you why value investing is outdated and give you an alternative. Why do I think value investing is outdated? The key principles of value investing is buying cheap companies. Yes, I know there is a lot more to it, and I get it from your comments. In fact, everybody has their own definition of value investing. But I will never accept that value investing is in the same category as investing in innovation. It is just not the same. To me, that is just trying to twist and turn the definition of value investing. So, I have many stories to tell you on investing failures, and I will give you some examples. These examples are very vivid in my mind because I've seen so many people around me years ago lost money. One of them is like back in 2015, some idiot financial guru said Lumber Liquidators is on sale. It's a great company. Financials look awesome. Plenty of market share. Simple business. Nation's largest specialty retailer of hardwood flooring. It is so cheap, let's buy. This was the stock chart of Liquid Lumberdators. Coming out of the 2008 crisis, the stock went up so much all the way until $120, and the stock fell $120 all the way to $50. Massive discounts from the high of $120, and it meets almost every single matrix of value investing. If you look at the revenue, it's constantly going up for 4-5 years. You look at the earnings per share, it is going up. It's an awesome company. Looking at even more depth into the financial ratios, the key ratios, return on equity, meaning to say that the amount of money put in, they get back how much? 15% returns, 20% returns, 28% returns. These are all above average stats for value investing. Returns on assets, that means the assets they have, how much returns they are getting back. Look at that, it's all above 10%, maybe 1 year less than 10, and it's constantly going up. This is a simple business, it just makes flooring, and suddenly some things happen to it, the stock price dropped from $120 to $50. Yeah, right, if you buy cheap, guess what? Years down the road, it got even cheaper to almost no value. If you zoom out, it looks like a big middle finger in your face. I got tons of examples, let's continue. Foot Locker.
So what I will say about this, it's for somebody that is new, this is pretty convincing, right? Because you look at the fundamentals, and then if it doesn't work out, he might convince you that value investing doesn't work. You see, looking at the financials, what you are looking at is past performance, okay? What happened in the past? This is what companies do. They report quarters that happened in the past. What happened in the past doesn't mean the same thing is going to happen into the future. So you can look into the past and you can learn about the quality of the company, what is so special about them, how did they make the company in the past, but it's your job to make the judgment call about what's going to happen in the future, whether this will continue. If you correctly estimate what's going to happen in the future and you are right on it, then you will get rewarded for being right, assuming you don't overpay for it, of course. If you are wrong, whether it was predictable or not, if you are wrong, the stock is going to decline, of course. But just because the financials look great in the past doesn't mean they're going to look great in the future. If you look at a company like Voxter, look at the financials, they looked horrible. And how come the stock is up 10x? Because it's all about the future.
I'm sure most of you have heard of this company. How do I know these companies? You see, when shit happens, investors will flood to me for my opinion. While I appreciate investors coming to me, they shouldn't be in this mess in the first place. This company is an American sportswear and footwear retailer, and they're operating in 28 countries. Wow! Let's look at the value investing matrix, the financial matrix. Let's talk about like the standard stuff like earnings per share, revenue, dividend, ROE, ROA, that kind of stuff. Let's go. Then after that, we'll go to the charts.
Again, it's the same thing. You're looking at the past. That doesn't mean what's going to happen in the future. It's your job as an investor to do your due diligence to see if whatever happened in the past is going to happen in the future.
If you look at Foot Locker, consistently you look at their revenue keep going up, which is good. The business revenue, it's going up, means more and more money they earn every year, even until this year, 2020. Earnings per share, wow, perfect. Look at the dividends, wow, perfect. The payout ratio is quite conservative at about 30%. And if you do the standard matrix, you look at every single numbers here, they meet the checklist. If you look down below, return on equity is pretty good, return on assets, and you look at all the numbers here, they are all in the green. There are seldom minuses here and there. So this is a typical workflow of a very good, financially strong company. If you look at these charts here, Foot Locker has been around for a long time, since beyond 1998 all the way. And you look at the stock price has been going up since the financial crisis. Wow, high quality company with amazing numbers. And one day from like $70 nearing 80, it drops to $30. Cheap. Wow, it is really cheap. Yeah, right. If you, as I said to you, if you buy cheap, it goes cheaper. It's like catching a falling knife.
So I don't know anything about this story, but I can guarantee you one thing. If it got cheaper, that means that the financial performance of the company got worse, which means this is an argument that value investing works very well, because if the fundamentals deteriorated, the stock price got crushed even further. I guarantee you that if the financials continued to be as pristine as they were in the past, this would have never happened. So saying that value investing doesn't work just because the past financials looked great and the future financials don't look great is extremely naive.
This is value investing. You get my point by now, right? So now stocks are crazier. If buying cheap is a stupid idea, what do you do? Okay, this is not my first time saying this, but I will keep repeating it because you need to know. The question you need to ask is, what is the only matrix that will ensure the company's growth? No economic moat, copyright and patents are going to protect a company. Look at what happened to Kodak.
So what he's talking about here is the moats that Warren Buffett talks about, is that switching costs, cost advantages, network effects, intangible assets, and efficient scale. It's moats that can protect the company's revenues. Of course, the moats protect the company's revenues. Now, some moats are more durable than others. Some moats get eroded. Some moats get bigger. I mean, let's think about his YouTube channel, for example. His YouTube channel has almost 300,000 subscribers, okay? Look at the kind of views that he gets on his videos. 354,000 views, 122, 138, 189, 143, over 100,000 views, right? Look at my YouTube channel. almost 7,000 subscribers. Look at the views that I get. Oh, you know, close to 1,000, 2,600, close to 1,000, over 1,000. I am about $1,000 per video, right? Now, if he has his advertising turned on, he's making more money for advertising if we're just looking at that. And so other words, it doesn't matter how great my content is. It doesn't matter if I stand on my head, if I spin on my head, if I scream, if I give you good content, it doesn't matter. He will always have more views than me because he has a moat. He has more subscribers, his channel gets more views, so YouTube pushes his videos. He will always make more money from advertising than me. It will take me a long time to catch up to him. That's a moat. So moats, of course, they protect businesses from competitors. Of course they do. But moats can definitely be eroded and they can be strengthened. It is your job as an investor to figure out what kind of moats a company has and whether the moat is strengthening and the durability of that moat.
Company. Look at what happened to Kodak. Look at what happened to the taxi industry, etc. The only
Yes, what happened to Kodak? What happened to the taxi industries? Okay, they had a moat, they had protections, and that moat got eroded because something else was introduced that was better and disrupted that industry. Of course, just because there is a moat doesn't mean that the moat is there forever. It is your job to figure out the durability of that moat. Just because you cherry pick moats that got eroded doesn't mean value investing doesn't work. Let's take a look at the second video. Warren Buffett versus Cathie Wood of ARK Invest. Value investing versus technology and innovation. Ooh, I'm looking forward to this.
So let's look at Warren Buffett's returns versus Cathie Wood's returns. This is ARK Invest performance and Cathie Wood is the portfolio manager here. And so let's compare this with Berkshire Hathaway. So let's click this. Oh my freaking god, the red here is Berkshire. And if you look at this, you see the difference between this and this. So which would you rather be? This is like absolutely nuts and crazy. Now,
remember the video that I made saying that people in the financial media, which includes him, don't understand the difference between investment performance based on the underlying fundamentals and investment performance based on stock prices. Let's have a look at Berkshire Hathaway. Since the time that he made the video, right? So he had a little bit of drop here. The stock of Berkshire Hathaway is a double. And by the way, the stock was included in this book, right? And during the sell-off, the recent sell-off, look at this. Did we give up a lot of gains? Nope. If you read this book and you bought Berkshire Hathaway because of this, during the COVID sell-off, because it was trading at a reasonable price, you would have doubled your money and you wouldn't have give up any gains. Let's take a look at ARK Invest. Look at that. Zoom and back down, right? So he's using this moment here. Oh my goodness, how Cathie Wood is doing great because people like him talk on their investment channels, buy, everything Cathie Wood, that she gets on CNBC, everybody bids up her portfolio for the wrong reasons, and then she crashes all the way back to where it was. This is the difference, okay? People cannot tell the difference between the performance that's true performance based on the fundamentals and then the performance that's based on hype and a bull market. In a bull market, everybody's a genius. In a bear market, you can separate the best from the rest.
I shock every one of you. So let's go deeper and understand what the heck happened to the most successful investor in the world. So I just want to say this before I move on. Look, I really respect Warren Buffett a lot. I learn lots from him. I apply what's relevant.
I don't think you learned anything from Warren Buffett. I don't think you learned anything from Warren Buffett by saying what you're saying.
So why do you think during this crisis my portfolio jumped? It looks like ARK Invest portfolio but more. Like what Cathy would always like to say, and I quote her, innovation.
His portfolio jumped because 80 or 90, something like that, 80 to 90% of his portfolio is in Tesla. Okay? That's why it jumped. And it jumped because he got lucky, okay, on Tesla. Now, I'm not saying Tesla wasn't successful in producing an electric car. All I'm saying is that Tesla is nowhere near being worth what the stock market is saying. And if Tesla can deliver the kind of financial performance to justify the current market cap, I will say I was wrong. Tesla delivered what they promised, and the people who own Tesla deserve to get the kind of return that they got. Just because the stock price is there, because every other YouTuber is making videos about Tesla, has nothing to do with investment performance and everything to do with luck.
Gained market share at accelerated rate during tumultuous times, like better, faster, cheaper, and more productive. So think about what internal combustion engine did and took over the horse. So this is a picture of Fifth Avenue back in 1900, Fifth Avenue, New York City. So among all this, these were all horses and carriages, and there was one automobile. Let me zoom in. There was one automobile. But in 1913, just 13 years later, the same place, not a single horse left. However, in 19...
So he's using this as a proof that Tesla is like the right investment. Do you know how many car manufacturers failed before the transition was made? You see, this is what happens with innovation. Innovation takes a lot of time to take place, and you don't have a lot of concrete evidence as to who is going to win. Okay, and those that invested in Tesla, even Elon Musk at the beginning thought that Tesla was going to go bankrupt. So the chance of that Tesla success was very slim. And people that invested in Tesla, they were successful on a very low probability. And then they started, like people like Meet Kevin, started to talk about other electric whatever manufacturers, and pretty much all of them became unsuccessful because they were successful on one, and then they thought that they were going to be successful always, because everything they touch, everything they read about, every innovation, every disruption that they think about is going to be successful. Most of the time it's not. I would say more than 99.9% fail, and only a very small percentage succeeds.
So like Warren Buffett during his younger years where he outperformed, he mainly owned a few companies. I think it was like Gecko, Coke, Amex, IBM. I may be wrong, but it sounds something like this. And Charlie Munger only had 3 when in their...
Okay, what so many people seem to not understand about Warren Buffett is that he outperformed in the early days because the universe of investments that he had when he was managing smaller amounts of money was huge. That's why he outperformed. The reason why he's not performing as well today is because the universe of opportunities that he has to himself is very tiny. That's why. So, chicken genius, you learned nothing from Warren Buffett. Nothing. Let's listen to now why value investing is impossible, how to invest in 2020.
Friends, I really do not know how to say this nicely, but my goal is always to tell it as it is. So most of you know that value investing involves some kind of method of calculation. The biggest problem is there is no way to calculate value. If there is no way to calculate value, how do you even evaluate if the company is cheap? So before I start bitching, appreciate the early thumbs up. What do I mean by there is no way to calculate value? Within a company, there are usually like machineries, computers, assets like property, even database, etc. All these have certain value. Yes, I get it. You can go into a company, count every single wire, every single computer part, every chair and table, every machine, and I assure you, your numbers will be wrong. A company may buy a computer, let's say for $1,000. The asset of the company will increase.
I don't know what he's talking about. He's just talking about the company's assets. And I do agree with him that calculating value 100% correctly is impossible. You estimate based on your assumptions. Based on your assumptions mostly of what the company is going to generate in terms of revenue, in terms of free cash flow, in terms of net income. You have an estimate range, and then if the range is, let's say, $10 to $20 per share, and then the stock is trading for $2, it doesn't take a genius to realize that, okay, I might be safe, I might be getting a good deal, but if the value you're calculating is between 10 to 20 and the stock is trading at $1,000 like Tesla, it doesn't take a genius from Singapore to realize that it is ridiculously overvalued.
I used to be a value investor. Thank God I moved on with the times. This is not like the 1980s. So in the 70s and 80s, information wasn't like so freely available, and those who had better access to information took advantage of it. It's 2020, man. The internet has connected the world. Warren Buffett's value...
Now that's actually a good point, that I'm going to plug my investing strategy, because he's saying that, today all the information is available. And do you think all the information is available on microcap stocks? This dude doesn't even know the microcap space exists. Microcap stocks don't even have any analysts covering them. So pretty interesting, isn't it? That you can go into the microcap space and you can get an informational advantage, but you can't get the informational advantage in the big names, according to what he's saying. So, hint, hint, maybe a microcap space is not a bad space to be in.
I learned this from the man himself 6 years ago. I think it was back in 2014. You know who I'm referring to. This has made me more grateful to the little things in life, looking at the big picture and keeping myself grounded as I climb the ladder of life. So how should one investor approach investing now? It's pretty simple, at the same time, like more complicated. But those who get it, gets it. One method is by Chemath. In my opinion, he's one of the best investors out there. Investing 101 is an easy test to figure out which public companies you want to invest in. So do the following.
Okay, so, oh my goodness. Cathie Wood is one of his idols, and then Chamath is his second idol. Oh man. I hate to say it, but it's probably a good thing that you quit YouTube. And like other people are saying you should come back, just stay away from YouTube. Because if these two are your idols, you will continue destroying people's financial lives.
Like on the iPhone, setting screen time, see all activities, and week. If you are not willing to own the products you use, then what? The other method is super simple method, and it worked every single time. You see tons of people using the same product or service. Never ever bet against these companies. Think about it. Every single company made it. Think Google, Apple, Netflix, Spotify, Tesla, Amazon. It's crazy for anyone to short a company with tons of raving fans. It is absolutely nuts. Look at Zoom's stock price now. It doesn't make sense, but because tons of people are using it, the stock price has rocketed to the moon. Concluding...
Okay, let's look at Zoom. Okay, the stock price rocketed to the moon and came down to earth. Chicken genius, what's going on? How come it came down from the moon? I thought it was going to stay on the moon. You know why it came down from the moon? Because it was overvalued. Nobody was paying attention to how much they were paying because they were having a good time watching your videos and listening to Kathy Wood and just paying whatever price without any attention to what they were paying for. Okay? And now look at all those losses. It is back. Zoom is still a little bit higher. Well, let's see. The pandemic started somewhere around here. Zoom is back at the same level that it was before the pandemic started.
In this video, those who refuse to change had many missed opportunities and will continue to have more missed opportunities while bitching to the world that companies are expensive. My goal has...
All right, I've had enough of this clown. So, unfortunately, this is what happens, okay? People are unsuccessful with intelligent investing. They get drunk on Bitcoin, Tesla, growth stocks. They have a little bit of success, then they crash down to earth, and then they end up quitting because the truth comes out. Stock market is the voting machine in the short term and a weighing machine in the long term. Learn this, get it into your head, and hopefully you will succeed in the long term. Thanks for watching.